Good afternoon. Good evening, everyone. Thank you for joining today. I am very excited to be moderating today's discussion on how tactical trading and price discovery helps or hurts the goals of the voluntary carbon markets. That was a revision of the title that I just made. My name is Carrie Constabile. I work at Standard Chartered. As many of you know, Standard Chartered has a long history of leadership in the carbon markets. Our CEO, Bill Winters, chaired the task force on scaling voluntary carbon markets. And in our capacity as chair of Net Zero Banking Alliance, we are working together with many banks, many of whom are on this call, to assess the role of carbon markets in meeting bank net zero commitments. As I'm the head of our sustainability strategy and net zero team at Standard Chartered, and in that capacity, I'm looking forward to moderating today's discussion. My goal is to bridge the technical trading expertise on this panel with the broad perspectives represented in our audience and in the increasingly diverse carbon market. I'd like us all to engage informally and challenge one another today, particularly regarding how we can ensure integrity and quality in our daily markets work. So I'm joined today by many leading carbon market experts in the trading field. Yuhao Liu, Vice President of Environmental Commodities for Morgan Stanley. Chris Kennedy, CEO and co-founder of Fortinbus Asset Management. Julian Hall, Pricing and Data Products Director, Climate Impact X. Juliette Vidal, Portfolio Manager of SCB Principal Carbon. So just as for the audience, we will be saving time at the end for questions, so please do send them in, and we'll open up after the discussion amongst the panel members. So as we all know well, the voluntary carbon market is at an inflection point for many reasons. Demand has increased, the bar for credibility and integrity is higher than ever, and new forms of carbon credits like carbon removals are emerging. So in that context, I'm going to ask a couple of probing questions to our panelists, and I'll start with Chris. Sorry to put you on the spot.
Yeah, go ahead.
Chris, in this context, do you think that the markets should work to drive the cost of carbon as high as possible? And why or why not?
Okay. I think that there have been a plethora of studies, starting with the OECD and the World Bank, that all point to the necessity of a much higher carbon price that's needed if we're going to meet Paris 1.5. So kind of from a directional perspective, I think it's going to be needed. But then it should be left to market mechanisms to make the transition from wherever we are right now to wherever we will be. So, I think to a certain extent we have, of course, the compliant market, which is not the focus of today's conversation, which has mandatory elements to it. But there's a merging really of the compliance with the voluntary, and I think that those two markets will be coming together. But the short answer to what you're saying is what you're asking is I think that the carbon price needs to be higher from an environmental point of view, but please don't mess with it. Let the market decide. We've seen a lot of the problems with the compliant market in the past couple of trading sessions, actually, but also a longer storied history of governmental interference in that market. Let the market decide. Again, anecdotally, today we saw a huge spike in the nature-based products for no discernible reason. So let the market kind of find itself. But I think broadly that the market does need to be higher, and I think that's part of the reason why we're all engaged in this, because of the necessity of a higher price for Paris 1.5.
Thank you, Chris, and hear that loud and clear. Don't mess with the markets. I'd like to open to other panel members to answer this. Does anyone want to volunteer to share? Do you agree or disagree with Chris's perspective?
Yeah, I guess I'll jump in. And thanks for the opportunity. And great to be a part of this. I think I would take just a shot at going one level deeper. I agree with Chris's comments in the general. It's the idea of achieving any target, 1.5 or even 2.5. At this stage, with the sort of the lack of urgency that we've seen so far, what's happening is that it's not so much that there's a desire for prices to go higher. It's more so that the longer we have delays, the more difficult the problem becomes. And if you think of it in a compliance market versus voluntary market perspective, the compliance market is driven, price discovery there is driven by a clear goal from a central regulator, so the EU government or the California government, that is actually what they're expressing as a regulatory target is a certain quantity, an actual number of tons they want reduced in their economy, their respective economy, in their respective jurisdictions. And for every given level of reduction, if you move across the time scale and you don't make progress to that, it becomes more expensive because it becomes more of a gargantuan task. At the same time, also, what's happening in those compliance markets is the price of carbon it cannot be expressed as an average price of carbon on the pathway to those very difficult reductions. That target price from a regulator perspective is actually meant to target the most expensive, the last ton of carbon that they need reduced. So all tons, right? So if you want 100 tons reduced over the course of 30 years, that last 100th ton may cost you $200 a ton. The first one may cost you $5 a ton. But you need that $200 a ton price signal to get all of those reductions into your program. That's the compliance market. The reason why the voluntary market has such a differential in price between what we see in EU and even in California is that the voluntary market, you have the luxury, because you're not compelled to do so. You can pick and choose which cost levels you want to participate in on your way up to that very high price level. So there's a reason why forestry is a bit more expensive than industrial projects and so on and so forth. It's because they're a little bit more expensive to operate. And so you get to pinpoint all of those price levels kind of along that curve all the way up to that very expensive credit. And so the marrying of those two, like Chris mentioned, the marrying of those two markets is what's going to converge price towards that compliance level. The more seriously people take voluntary targets, the more seriously people take voluntary actions, the more it's going to look like that compliance market.
Thank you, Howell. And you bring up a very interesting point. I mean, many interesting points, but one of them is the bifurcation of the market, which right now, I mean, we are, as I mentioned, we're at an interesting inflection point also because of greater attention to carbon removals. And this is a question I'd like to pose to Julian, and would love the rest of the panel to jump in. I mean, as lack of standardization, as you have mentioned, is increasingly a challenge as the market diversifies. And there is in the voluntary carbon market community a robust discussion happening right now about splitting, so to speak, the VCM into potentially three different markets. One focused on reduction, where, as we know, avoided emission or offset. Two, removals, and those would be high permanent removals, such as direct air capture, biochar. And three, protection. So that would be reforestation, avoided deforestation. I'd love to hear your perspective, Julian, on this discussion of bifurcation and how, if it were to be realized, how would it impact your work?
So first of all, thanks for inviting me to speak. The conference has been great so far, by the way. I think just building first on Juhal's point just previously, a high price in the VCM market does help to support projects that are higher on the cost curve. So generally, harder to do, or even for there to be better projects in general, you need higher prices to support that. So generally, higher carbon prices in the VCM is helpful across the cost curve, and it helps those projects at the higher end of the cost curve to be able to, survive, manage, etc. So generally, a good thing. I think, like Chris, I've been exposed to. I believe that markets function generally pretty well when they're left to their own devices, and I think an artificial bifurcation or a artificial split between different categories of types of credit types could be rather unhelpful. Like, markets have a tendency to kind of naturally self-correct through supply and demand dynamics, and I fear that separation could kind of be counterproductive in unexpected ways. I think the voluntary carbon market will naturally settle into a place where there will be clusters of credit types that will behave in similar ways, and but I don't feel that there needs to be a sort of artificial involvement in separating them, if you know what I mean.
If I can kind of just jump in there real quickly, I think, Carrie, that the way you're bifurcating is one dimension of bifurcating and looking at it that way. I think certainly when you talk about avoidance, you deal with the very conceptually challenging concept of a counterfactual. What would have happened if that hadn't happened? And so, like, okay, what the hell? It's confusing to get your head around. And certainly the idea of removals has a lot more tangible element. I would support the Julian's view in general that the bifurcation, either by necessity or certainly if it's imposed by external regulators, certainly not good. But when you're talking about, it's more of a market-driven bifurcation. But there's another dimension we can look at, which drives me absolutely crazy, and that is the bifurcation according to vintages. Somebody set an arbitrary line in the sand at 2016 and said, okay, pre is junk, post is okay, and then therefore it trades at a discount pre and a premium post. And I can conceptually understand why that is the case. In the same way, I can conceptually understand why removals versus avoidance is also a natural tendency. But I think at the end of the day, a ton of carbon is a ton of carbon. And as long as that has been assessed with accuracy and integrity and transparency, which wasn't always the case, which may explain why older vintages trade at a discount to newer ones. But a ton of carbon is a ton of carbon. And then it really shouldn't make so much of a difference in terms of its bifurcation. There is perhaps one level of bifurcation that I would support, and that might be using the idea of credit. Now, I come from the fixed income world, where in the standardized fixed income markets, you have investment grade and you have non-investment grade. And I think that's really where the market's going to head, that the investment grade credits, whatever criteria that they're evaluated against, will trade at a premium to the non-investment grades. And that might be according to geography, that might be according to vintage, that might be according to technology or whatever. But I would really support kind of, if you will, if I had to choose a metric to bifurcate along, I would say investment grade versus non-investment grade, and then lump everything else into the defining criteria for those two. But yeah, that's just kind of my 2 cents on the bifurcation issue.
Thanks. Please, Juliette.
Yes, thank you. Thank you very much for having me here today. I'm happy to have this discussion with my fellow panelists, and I think we've already talked about many different topics here. But as Julien mentioned, I think it's important to go back to the supply and demand dynamic of the market, in the sense that if you look at the data this year, obviously demand is growing, but supply is growing faster, right? So this is the main factor that explains that this year the prices are going down for carbon. And that's a market dynamic, right? So I think that's the first part that's really important. Then if we talk about segregation, to some extent, the development over the last year of futures contracts, for instance, they have been helpful in segregating different types of carbon into different types of contracts, right? And I think that's been very helpful for also a lot of different players to come in and provide liquidity to the market. The only concern there is if you actually look at the futures markets, as they're categorized into very specific criteria, the thing that you will find in that very specific criteria is the one that fits the exact criteria, not better. That means in the end, if you take this as a benchmark for pricing on the market, typically, the benchmark is the least desirable category of projects as perceived by the market. Now at SCB, we're merchants of voluntary carbon. So we source directly from project developers, and then we sell to corporates or institutionals who want to reach their sustainability goals. We've never heard any one of them tell us, yes, we'll be happy to receive a basket of the least desirable thing as perceived by the market in the future.
I'm happy to chime in on that. I don't want to monopolize the conversation, but as a market maker, specifically also in the futures market, this really does speak to my heart. I think that there's some inefficiencies right now in the way the futures markets are set up, and that has to do with what I was just talking about, vintages. But in general, I think that the concept of having buckets and having a benchmark to which will be priced by definition according to the cheapest to deliver, and I would use that terminology rather than kind of the junk or the lowest quality. It's simply the cheapest to deliver, in the same way that, well, again, the fixed income market has a treasury future and it's priced by the cheapest to deliver in it. I think that what I see is that is a necessary development for where I see the market going. And the way I see the market going is the responsibility for voluntary, for the VCM for offsets is going to move from the marketing department of a corporation to the treasury department of a corporation. The SEC is going to say, hey, you S&P 500 company, you have to report this stuff. The CFO is going to say, hey, whoa, wow, okay, I got to get going on this. We'll tell the treasurer, hey, offset 500,000 tons, and he's going to go out there and he's going to buy the cheapest to deliver. And I don't think there's anything inherently wrong with that. In fact, I think that that progression is probably the right way for it to go. But it's part and parcel of kind of a larger conceptual movement from offsets being a marketing ploy. Hey, we're Microsoft, we offset everything, and here's a colorful brochure of all the pandas we've saved, to a very hard-nosed, knuckle to the ground, price-driven type of a process where the treasurer will say, hey, I don't really care so much about pandas, or CCB for that matter. I don't want to open that can of worms, but that's also a subject we can talk about. But CCB shouldn't have anything to do with this. It's a ton of carbon. I need to offset that right now. And the futures is a good way to do that, because I just go out there and buy it. As long, again, Juliette, this gets back to your point, as long as it ticks off some of the basic boxes. There's been a lot of initiatives with the CCP, core carbon principles, and the VCMI is also coming in terms of establishing the framework. But once that is set, I think that it's going to be a commoditized product, and treasurers are just going to go buy the stuff as cheap as they can, and kind of avoid, if you will, the virtue signaling that's associated with carbon offsets that permeates the market right now. Again, sorry for my monologue on that one, but that's a very passionate point that you're speaking to.
Thank you. I think you have, please, and that.
Oh yeah, if I could just, I think this is a really interesting discussion, and I just to kind of pull from threads of what Juliette and Chris both said. I think the fact that, so From the perspective of the environment, carbon is scarce. It's definitively a scarce resource. From the perspective of the market today, with respect to the lack of compliance coverage of carbon markets in general, the fact that we have a voluntary market, a robust voluntary market, is actually essentially what we're dealing with is, as the market is today, it's an oversupplied market, right? for the reasons, and Juliette kind of pointed to some of the supply demand metrics there. And so this ability for voluntary market buyers and users to have their choice of credits, for there to be a spectrum of within a certain category, to say I don't just want the standard contract that the standard attributes that the futures exchange will deliver to me. I want to go out and pick and choose my favored attributes beyond just those basic ones. I want the CCB. I want particular types of CCB attributes. I want particular types of SDG attributes. To be able, that by definition, you're facing an oversupplied market. So part of a lot of this relative value and relative sort of, relative pricing and all this sort of disaggregation in the market goes away if we start to take this asset class seriously. If we're in a world where it's now supply constrained, then buyers will not have that luxury and prices should converge. And that means not just within the forestry sector, not just within certain CCB elements and others, but even across the CORSIA eligible stuff, the energy related stuff, the industrial type projects that is currently priced at a third or a half of what the forestry sector is priced at. Now, so what we tell our clients, because we have a lot of within Morgan Stanley, we have our market-facing kind of trading desk, which I'm a part of, and then we have our broader client platform, where a lot of corporate end users come across our desk asking, what should I buy and what should I get into? And what we say right now is, in this world that is oversupplied, what you want to look, that the product is commoditized in only one dimension, and that's that's the metric ton of CO2. Everything else is actually, every other project carries with it a bespoke package of attributes. And what you're really doing when you're buying this right now is you're buying these attributes that are currently, in some cases, like in the industrial emissions projects, undervalued relative to some of the marketing-driven forestry assets that could potentially be overvalued by price. And so to break that down and to say, what am I actually buying? Am I buying permanence risk? Am I buying leakage risk? Am I buying geographic risk? Right? And how do I allocate my dollars in a way that can, where I can manage those different types of risks? Right? If you buy too much forestry, are you overexposed to permanence risk? Can you shore that up with methane capture that does not have permanence risk? Right? What are you actually exposing yourselves to? So I think it's a really interesting discussion, and it's really just a subject that is relevant today, and hopefully, if the market kind of takes off in the future the way we all hope it will, those who kind of diversify themselves across these different attributes will see that relative value and see the benefit of that relative value converging as we move forward.
And you bring up a couple of very interesting points. One is the development attributes in the VCM, right? It's obviously carbon is the easiest to measure and but how do we incorporate? I mean, what are successful ways in which we incorporate sort of SDGs, development measures, et cetera, and price those in? I think just on and mindful of my role as the moderator, so I won't put too much of my point of view in. But I think, Chris, you I personally was a former purchaser of carbon credits from a corporate, and I think corporates are in a very good way, very driven by quality, and several of them are going in, and also very committed to the CCP process. So I think that I think it's I understand the treasury, the dimension, but I think I would be surprised if corporates get to that point where it's only price is driving. But I'd be curious to hear other panel members' perspective on that, and then so maybe I'll call on Juliette if you don't mind, and then I think we should touch on the CCP because I think it's on everyone's mind.
Yeah, sure. I think to talk about sort of corporate buyer preference, I think commoditization versus this kind of continuation of having bespoke preferences is not a zero-sum game. It's not going to be one or the other. I think it will continue to be both. There will be some degree of commoditization, but I do think some corporates have very entrenched preferences, whether geographic or credit type related. So I think single project trading is here to stay. I think broking, OTC broking is here to stay because there's a need to allocate credits to various corporates around the world with very diverse preferences. And I think, yes, in a tighter market, you'll see some of those more price sensitive corporates become less picky. But I do think some of them, especially if their margins are good, right, will continue to just pay more for the credits that they want. So, yeah, that's my view.
Thanks, Julian. There's actually a related audience member question that from Sheldon Zakreski. Right now, many corporates buy offsets on a spot basis because they don't want them to show up on their balance sheet. Does the shift from CSR to treasury-driven offset purchases signify corporates will largely engage in forward transactions? Maybe I'll pose this to Juliette, if you don't mind.
Yes, thank you for the question. I think that's actually an excellent question, and it touches to the forward curve as well, right? We have seen it steeply rise over the year, and it did bring some transparency into the market, and it's a good measure for corporate looking into forward investments. But to bring it back actually to that desire of purchasing spot credits, one of the concerns that were raised to us is why would we pay in the future for an uncertain outcome when we can have a proven solution in the present? And that's actually exactly the case where you have projects that have been existing for the last 10 years, say. They have proven and permanent CO2 emission reductions, which is, as Juha mentioned, really the metric, the only metric that we have. So I think this is an important point to bear in mind at the moment.
Well, if I can just chime in on that very briefly, and then we can switch to the CCPs. I think the forward curve has become essential. I mean, it is essential in every other commodities market. Now, you may not like my use of commodities given the bespoke nature of a lot of the transactions, but I think it will be very prudent for a company to be able to say, all right, fine, I emit 1 million tons today, and I know what my forward carbon intensity of my business will look like, and it is prudent today to be able to go into to hedge that in the same way that you do with an interest rate risk. I mean, hell, if you're a treasurer or if you're anybody, if you're a house buyer, you kind of hedge your future interest rate risk through various mechanisms that the market offers. So I think that maybe I'm a little bit of the dissenting view on this panel, to the extent that I really do feel it's going to become a lot more standardized. I think a lot of these bells and whistles, as I call them, almost disparagingly, will disappear. I think there are attributes that are very germane to the pricing element, one of them being geography. But in this gets maybe carry into the CCPs, which I wholeheartedly support, with the one exception of the SDGs in that. But I do think that having a standardized body that says, all right, this is what we kind of deem as being if you will, the bar, the hurdle bar, will be a wonderful development in creating transparency and some integrity, like the name sounds. But I don't want to jump the gun on that one there. But I really do think that the CCPs in general are a wonderful development.
Yeah, and if I could just add on this concept of forward, I do think that it's an interesting point. I mean, I think that the problem with a pure forward, meaning getting exposure to forward production, future production of offsets from projects, is that the buyer ends up taking an incredible amount of operational risk, potentially regulatory risk, political risk, depending on how this Article 6 process plays out. If nations, we've already seen some nations step in and say, actually, private contracts don't have the right to sell carbon, right? Nations kind of stepping up and saying they want to kind of claw back the ownership of carbon rights. And so you do take a lot of that. Now, the other type of forward purchase is what Juliette alluded to, which is essentially financing a purchase of spot tons, right? So if you can find, if your need is 200,000 a year for the next 5 years, and you can find a financing partner, like a bank, like Morgan Stanley or somebody else, who can buy those 1 million credits for you today that are already issued, so they don't face that operational risk, but then sell them to you in pieces over time, right? That's one way of constructing a forward market that I think is viable today, and that sidesteps those types of operational political risks. And then the other thing that's interesting is this is where the futures markets come in as a useful tool. Not just because there's the issues with with the sort of standardized products, and we kind of have different views on how those standardized attributes are going to behave over time. But the benefit of having that futures curve is it's visible. You can actually access that price and give yourself price exposure over time. And then the way the market trades, once you have that exposure to the underlying price of, let's say, the December 2025 contract, or maybe even beyond, at that point in time, you will still only, if you want to exchange, and this is how power markets work, this is how essentially futures and physical energy markets work. You hedge yourself with the future, and then when you approach the spot, right, when that December 2025 becomes spot, what you can do is exchange your futures exposure for physical exposure. Because in 2025, you will see the vintage 2024 credits that made it through all that political risk, that made it through all that operational risks. They are in the spot market. So you may have to pay a little bit more to sell out of your futures position and buy into something that is spot available, that is vintage 2024 or beyond. But at the very least, you have that relationship. And so the overwhelming moves of the underlying product, you still will own, and you won't be, will sort of be de-risked.
Well, I think that opens up a wonderful discussion, which I won't necessarily address this because I know Carrie wants to talk about the CCPs. But of course, how do you price the forward curve? And there are wonderful anecdotal evidence of huge mispricings over the past 6 months in the current market right now, simply because it's a bit of the Wild West. The DEC 2025 is just horribly illiquid right now. And wonderful initiatives with all the exchanges out there. There are at least 2 or 3 or 4, I won't name them by name, that are coming along. And yeah, we just need to build liquidity in those so that people can do exactly, Hugh, as you're talking about, be able to hedge those forward exposures. But sorry, Kelly, I mean, over to you. I think you wanted to talk about CCP, and I keep bringing us off base.
No, it's fine. This is the point of a discussion is that we actually speak and don't. So on that, I'm just going to digress. One audience member did comment on the oversupply question, which I think is a good one, from Andy Secchiano. I'm still not clear. Could the panelists explain how we are in a carbon credit oversupply at the moment? And thank you for saying carbon credit, because we're not only speaking about offsets today, we're speaking about all credits, right? If we are in a carbon credit surplus, we have no problem solving net zero targets, right? So that is the question from Andy. Would anyone on the panel like to address that, to explain how we are in a carbon credit supply, and if we are in one, why aren't we solving or meeting net zero targets?
I think.
Go ahead.
Sorry, you have. Just on the oversupply part, I think it's good to simplify this for the audience and say that actually carbon credits come from internationally recognized registries which massively share all their information. So if you look at the publicly available information, you will find that there are credits which were issued, so exist on the platform, but were not yet retired by a consumer. There are credits that are actually verified, so a third party came and said they did indeed reduce CO2 emissions that are not yet issued but could be used in the very short term, let's say it like this. And then there's a number also of planned projects which have also been approved and which will issue volumes. So if you compile this all together from several different registries, it shows that at this moment there's an oversupply of volumes on the market. It is true indeed that what we've been told is that by 2050, demand will outstrip supply, right? That's true for 2050, but that's not true for the next 20 minutes, unfortunately, and probably not for the next 6 months, but I don't have a crystal ball. And this is why I think in this panel, it would be interesting to get back to the standardization and commoditization debate, because actually we try to make a reality which is very complex, much simpler than it actually is, right? If you look at the project categories, in 2021 at SCB, we counted 139 different products on inventory, specifically. That can include the geography, it can include the vintage. So I think this is, first of all, a very interesting data. Now, in most commodities or standardized contracts, you have a limited numbers of qualities, or at least within these set qualities, you can really find an interchangeable project. That's a thing at the moment for carbon that you cannot find. And if you look specifically actually at the contracts for nature-based solutions, for instance, there's an extremely wide spectrum of projects that could fit exactly those requirements, right? So at this moment, we're very far away from standardization. This is on the supply side. And then on the buy side as well, with corporates, it's like trying to commoditize, credit bonds, like corporate credit bonds. The bond for one company is not going to be the same as for the other company. You can't interchange them because they really fit their exact economics and the needs of the company. And I think this is why the market is really complex.
I would agree with the complexity thing. I would disagree with kind of the analogy with corporate bond. I would say that I would flip that almost on its head by saying, yes, in the same way that there are a heterogeneous group of corporate issuers, there are ways to standardize that, and it's been done in the credit derivatives quite successfully, I think. But
then you're placing yourself from the sorry, excuse me, Chris. You're placing yourself from the investor perspective, right? You can standardize a tool which is a vehicle which can contain a set of different products. But if you're exactly, the seller and the producer of the product in question, and on the other side you're the end consumer, that concern still remains. And this is why it can't be easily commoditized. It can for someone who wants to invest into it, bring liquidity into the market, but specifically for the fundamentals of the market, that's not the case.
Well, it is yes and no, in the sense that they will trade then to a spread to that standardization. And I agree with you to the extent that if Apple is not the same bond issuer as Microsoft, they might have, I don't know what the ratings are, but even if they do have some ratings, they certainly do trade at different spreads to each other. So there is a degree of kind of wiggle room within that. But I think that the general well, again, I come back to my mantra, is I think the general trend is going to be more of a standardization and less so as from a homogenization. With all due respect to the individual projects, an individual project developer in Ghana will think, my thing is substantially different from anything else in the world, but the market does lump it into this thing called the NGO contract right now, and that's a very broad bucket. And kind of, when you buy that stuff, I know that when I get delivered that stuff, I'm like, oh, what did we get today? It's kind of a bit of a surprise box sometimes. With all its.
No, I think UHAO has been been patiently waiting for a while and has a very point. So I'd like to get make sure Juha has and also get to some audience questions. So
yeah, I just wanted to touch on. I kind of see. It's funny because I think between the four of us, we have. If we count all our views, we kind of merge them all together. They kind of form a somewhat, I think, cohesive picture of the way the market is working. And I really, this tension between the standardization and the specialization, I really see as to the audience members' question to that point is, this is an oversupplied market. This is a symptom of an oversupplied market. The reason why we're oversupplied in carbon is what Juliette alluded to, which is, these carbon neutral targets by corporates are 2030 targets. They're 2035 targets. They're 2040 targets. There's no reason to doubt their sincerity on a sort of a threshold level, but they are not 2022 targets. And that is and we are very early days in even these targets being established, right? I mean, we really saw a momentum. I would argue in the last, maybe since the latter half of 2018 through to now, I think there was a count done at a certain point mid last year where it was something like 25 to 30% of the S&P 500 companies had at least some form of carbon neutral target written down or publicly announced. That's still only 30%. There's a lot of room to grow. So the entire, it's almost like this market is facing kind of a binary outcome inflection point in many respects, which is if you take these targets seriously, if you take the pace of companies making and establishing targets seriously, and if you continue that trend line, again, from the environmental perspective, carbon is a scarce resource. If you take it, but from the compliance coverage, from people being compelled to buy, from people being out there buying in the voluntary space, that activity has not caught up to the actual environmental outcomes. What we're talking about in the market today is will it get to a point where the market takes carbon as a scarce resource, where the market starts to appreciate it as a scarce resource. And then I think all of these problems or I think the answer to this specialization versus standardization question can only be answered in a market that becomes a little bit more balanced between supply and demand.
Yeah. If I may jump in to just build on what Juha is saying, I come to this market from a very much a commodities kind of perspective, having sort of spent a lot of time in metals and agriculture in particular. And, I've seen commodities develop tools to price individual criteria of the commodity. So this can happen in crude oil with sulfur escalators. It can happen in wheat with protein diffs. It can happen in iron ore with alumina differentials. But these tend to be criteria that are not too plentiful. So first of all, if the commodity has many criteria, it's very challenging to isolate the value of a diff, and they tend to be very liquid. I think personally that carbon projects and VCMs will struggle to develop diffs for the variety of criteria that are available because of how many criteria there are. And I think what we might end up with is a reality where the unit that is being traded is really a project vintage combination. For example, Katingan 2017 or Rimbaraya 2020, which is already what we're seeing today. And people will start to develop diffs at project level, which already is starting to happen. And I do agree with you how that, when the market tightens, end user preferences become much more price sensitive, and sometimes they're able to consume, pretty much anything. So in an oil spike, refineries will buy any type of crude oil, whereas when the market is okay, they have preferences, right? They prefer certain types of crude oil. Same thing for steel mills and their purchasing preferences. Same thing for flour mills and their types of wheat that they buy. And I think the same here with corporate retirers who are the end of the chain for carbon credits. In a tight market, their preferences will kind of diminish, and But most of the time, they will want to express those preferences, and they will want to even pay up to make sure they buy an Australian credit or an Indian credit, because that's what they want to have in their reports, right, in their corporate sustainability reports. So I think there will be a standardization in the market, but I don't think it will involve criteria differentials at a very narrow level. I think it will stay very much project differential based in general. I'd love to talk about, we've talked a bit about forward curves. I wonder whether we also want to talk about benchmarks, because I think that's going to be a key innovation that will that will transform the market. But Carrie, I'll leave that to you to decide.
Just on this, Juliette, do you disagree? And Chris Kennedy, please forgive me for cutting you off, but I wanted to make sure that the panel members had time to also react to your feedback. Which, Juliette, it sounds like you do disagree with Chris's perspective that there should be heavy standardization. It sounds like you're on one spectrum of that. Could you clarify?
No, so I think standardization is very helpful, and it will help to scale the market. It will help to bring more financing to the market. It will help to bring order. And I think what is necessary for that to happen is a benchmark, a robust benchmark to emerge. Currently, people are using a proxy futures as a proxy benchmark, and that can work in some commodity markets. But I think standardization is very helpful to help mobilize and organize the market. It helps create logical product differentiation. It helps to create a fertile ground for the emergence of healthy and liquid futures. It helps to create professional risk management tools. There's a whole bunch of reasons why standardization is a good precondition to a healthy and growing market. So no, I'll sort of go back. I hope I've clarified that. I hope and I think the market will standardize, but I do think there will be, on top of these benchmarks that will help drive that standardization, there will be project level differentials which will continue to exist.
Yeah, and it's not. This is not in conflict with commodities markets in general. I think maybe we're putting too much, or that word standardization is doing a little too much work potentially, because wheat is a commodity that trades globally, and yet when you go to the grocery store or you go to your favorite restaurant, there's all different kinds of wheat that they may offer, right? Different heirloom types and organics and whatnot, right? But the bulk of the market is priced on these sort of standardized contracts. You could argue that every single diamond is of a different quality, and yet we trade diamonds as commodities, right? And so there's really no tension, I think, in terms of this market as well. It's going to develop in its own way, but I think the dramatic shift is going to be the tightening of the market. There's no reason, if we truly view the CO2 aspect as standardized, there's no reason why a methane capture project should be trading a third of the value of a standard forestry red project, right? If we truly believe in that CO2 commoditization.
Okay. So that's I think great segue to the question about CCP, and not to be now I'm labeled an ICVCM obsessed moderator, but so we all, just for the audience, there are two integrity processes that are underway. One is the Integrity Council on the Voluntary Carbon Market, which is the continuation of the task force on scaling voluntary markets that was co-chaired by Bill Winters and Mark Carney. The ICVCM has recently developed core carbon principles, and against which I'd really like to hear this panel's perspective. There also is, as was mentioned, a VCMI, which is more establishing a guidance for claims, corporate claims that are using in part carbon credits and other to meet net zero targets. That's a little bit different, but they're working very closely together. So the audience question is, how much does the unsettled VCM quality debate hinder liquidity development? And do you see high quality supply market liquidity materially increasing once the ICVCM core carbon principles and/or ratings agencies are able to adequately define quality and price?
Yeah, I think that the CCPs are a wonderful development that is part and parcel of a larger professionalization of the whole market, if I may use that word. What we're seeing with the CCPs specifically are 10 very, very well thought out principles, except for one. It's wonderfully that it excludes the idea of vintage, which is the kudos to them for doing that. They say a ton of carbon is a ton of carbon, which is our mantra has been like that all along. The problem is, how do you know that this ton of carbon really is a ton of carbon? And you don't want to be a corporate who's left holding this, having retired the project that turns out to be bogus in retrospect. So, what we're seeing in co-development with the CCPs are rating agencies, are all kinds of wonderfully scientific satellite imagery ability to be able to really say, all right, this is indeed, damn it, a ton of carbon. Maybe it wasn't beforehand 10 years ago, but it is now. So I think that really CCPs are part and parcel of a larger professionalization of the market, including but not limited to the technologies that are inherent in some of the rating agencies. And this is absolutely necessary for the development of my market. And then, if I may just go back to what I said 45 minutes ago, I think if there is going to be a bifurcation, it's going to be to investment grade, where people can, around a benchmark, can pick something that's a bit more secure, pay a bit more for it, and then something called non-investment grade, or whatever the hell, I don't know what we'll call it, but not investment grade, that takes this benchmark and that may be a bit on the riskier side, but then for that cheaper. And then, depending upon what the corporate treasurer wants to do, he can either go, a high price, high quality, or lower price, around a standard benchmark. But CCP's wonderful development. It was I won't say long overdue. It took a long time to develop, but that's my 2 cents on that.
Carrie, if I could just jump in on this one really quickly. As far as rating agencies go, I think they're a really good example of what's happening in the market, in the sense that they're taking complex projects and couching them into familiar terms like the ABC ratings, right? The basis for the rating comes from mostly publicly available information as listed on the registry, and takes the assumption that the carbon buyer cannot go through the complexity of all this publicly available information. So I think there's also a question about the additionality of the rating agencies also being private companies able to determine which projects are good projects and should deserve carbon finance. Because if we go back to the basic principle of carbon, it's bringing financing to projects which would not have existed if this carbon finance wasn't there. Now, if you try to kind of shape all the projects to look like the market dynamic that makes you comfortable because it is standardized, it is easier to trade and put capital into, it drives it further away from the initial purpose of the project. And I think some projects, at least from what I could see from the rating agencies, are rated in very similar terms because they have the same methodology. For instance, they would have the same documents on Vera, but actually they might be really different projects. And while you might discard one of them, actually the other one could have qualities that differentiate it. And I think that's important to keep in mind in general.
All right, thank you, Juliette. So I'm being told by our session host that we are almost out of time. This has been really a wonderful panel and brilliant experts here. So well done to to the organizers. I'd love to have just one quick thought from each of you, just a closing, on the topic of this panel. How in this market of quality, integrity, what is your sort of closing remark to the audience on how tactical trading, price discovery, and carbon trading can help or hurt the goals of the VCM?
I'll do this in 25 seconds. Listen, I think the role of carbon pricing will be so fundamental to the global financial markets that on the end of the day, the financial news will talk about the dollar, they'll talk about the U.S. Treasury yield, they'll talk about the S&P level, and they'll talk about the carbon price. That's the importance that I anticipate carbon pricing having in the next 5 years.
Thank you, Chris. Over Julian.
Well, it's quite a challenging question. I think tactical trading in general, and market transparency, liquidity, status will continue to evolve. I think there's a lot of evolution to come in this market, and I think, like Chris, that it will become very important for the world in general and in the financial community and financial markets. It will be much more talked about than it is today. I think we're in a little bit of a lull at this moment for carbon, but there's a lot more to come.
Okay. Thank you. Quick thoughts, Juha and Juliette, and then we're going to get cut off.
Yeah. So I would just say that, my interpretation, it's not necessarily a good or bad thing. Trading price discovery, it's more a reflection, it's essentially a measure of the pulse of the market. And the fact that we have all these different price signals is suggestive of the way the market is behaving today, and to check in on prices, how they behave, how volatile they are. It's really something of a health check. And as you see that progress over time, you see things converge and to become more like other markets that are maybe more efficient. Again, that'll just be reflective of how the market is evolving.
As I have a very short amount of time, I'll finish by saying I can give you a concrete example how tactical trading enabled to reach the goals of the VCM with the capital that we've generated in our involvement in the market over the last 2 years, that enabled us to recycle it into actual projects that we are now developing at SCB, and so make the capital flow back into the VCM. And I think that's one of the key components of future developments of the market.
Great way to end. Thank you. Thank you all.
Thank you.